So hello and as always, welcome back to Learning MD. So we're going to go straight through it. So we're going to talk a little bit about how we invest our money on Learning MD. So let's go straight to it. So before we did a previous video in that we talked about 3 funds we are actually investing our money. So every single month we invest our money in 3 funds. We talked a little bit about a stock index fund. We talked a little bit about an actual S&P 500 fund. And then we talked a little bit about another sector which you thought that was an actual good investment. It might be health. It might be other insurance companies, not necessarily health. It might be metal. It might be gold. It might be industrials, which goes interlinked with metal. It might be luxury. So whichever the actual sector you prefer, but we were trying to tell you that you should focus on stock index on S&P 500. Now, first of all, I just want to make it clear that this is no investment advice. This is just my humble opinion on how we invest our money. And before you actually invest any money, you should do your own due diligence before you actually invest, okay? But we're going to tell you what we do with the remaining money we have from the YouTube money that we earn, okay? Which basically comes mainly from ads and money that you give us. Okay, so let's go straight into it. Many of the times that you are thinking about funds, many of you ask me, why not do stock picking? Okay, so many of you have been asking me, I've seen in the comments of the other videos, why shouldn't we do any stock picking? Well, very easy. I think that 99% of the people will not beat the S&P 500 over 10 years. That's essentially why I think that most people will not actually beat the S&P 500 over 10 years. But then you'll tell me, okay, then why are you recommending all these sectors instead of just putting all your money on the S&P and the stock index fund, whichever it may be, of the whole world, okay? When I mean stock index fund, I mean of the whole world. I completely forgot to put this. From the stock index fund of the whole world, okay? So essentially, I would like to strongly suggest that you diversify, because remember that a stock index fund, I'm going to talk the one I have, which is the Vanguard, but there are many, Fidelity, BlackRock, there are many that have great actual stock index funds, which essentially you have to look for fees that are as low as possible. Essentially have at least 70 to 80% of exposure to the US market. So essentially I wouldn't worry too much if you have most of it on a world stock market. But essentially I like to have it separated me, because essentially I don't want to have everything on the S&P 500. It is true that I'm kind of overlapping if you have on one side S&P 500 and on the other side a world index, because essentially you are overlapping, but I still think that it's great to have. I would diversify depending on the actual money you have. So for instance, if I had 10,000 euros, I would strongly suggest that you divide it. I think that maybe I know that this may sound crazy, but I would strongly suggest that every time you make more and more money, in the contrary of what people think, I think you should be more cautious and more diversified. Now, Warren Buffett, I believe, was the one who said that diversifying is for people who don't know what they're doing. Okay, then maybe I don't know what I'm doing. So basically with 10,000 euros, I would try to have 5,000 on the world index fund. Remember, it doesn't matter really the actual, let's say, broker you use, or the actual, let's say, fund you use, or the actual investment strategy. Essentially, I would recommend DCA, which means dollar cost averaging. So every month, when you earn money, you put a percentage of that money into these funds. So world index fund, then I would put 2,500 on the S&P 500, which, yes, essentially you're overlapping, yes. And then 2,500 on the stock of preference. For instance, mine would be health, okay? Which technically there are some actual stocks which are in the S&P 500, which are about insurance or health or stuff like similar to that, okay? So now, once you've got this, I would say that what if if you're the type of investor that has 1,000 euros, then I would strongly suggest that you include maybe another sector. Maybe it's too much diversification, but if you've earned 1,000 euros of your hard work, I would strongly suggest that you do more, maybe 4 funds. So 25%, I personally, this is my way of seeing it. It doesn't mean that it's the correct way, but I would have some bonds, 25% bonds, then I would have 25% maybe S&P 500. S&P 500. Remember that the iPad sometimes does this about, it just reads this as an equation and it does the adding and summing up. So then I would do 25% maybe of the MSCI. So this is just an index, that means World Index Fund. And then I would use, for instance, 25% of Health Fund. Now remember, has it got to be always an actual, so all of these have to be actually index funds, meaning replica of an index? Well, not necessarily, but I think that in the end, the percentage fees drop significantly when you have simply index funds that replicate, the S&P 500 or the World Index Fund or the healthcare fund, whichever it may be. Now, what would I recommend? That you do your own research, that you do your own study before you invest your hard-earned money on an actual fund. Now, I would also strongly suggest that you look at performance fees. This means that if you actually, let's say that you get a fund which is from an actual manager which has fees. So for instance, let's say mine from the World Index has a 0.01 fee, but let's say that you had a fund that at least that's what they charge me, what they say they charge me, and essentially let's say you had a performance fee from a manager of 1%. Make sure that it's justified, the 1% over the 0.01, okay? It has to be very, very, very well done to justify the commission of 1%. Remember, in compound interest, 1% after 10 years, they're taking quite a lot of money. So from $100, if you take every time $1, over 10 years, $10, okay? So that's quite a lot of money, 10% of your investment gone. So beware of that, okay? I know that it may sound not like a lot of money, but if it outperforms the index, so let's say you've got a fund manager which has been outperforming the S&P 500 for the last 10 years, then go ahead. But I haven't seen that many, to be honest, okay? So I'll leave you that to it. Another thing I would like to suggest you is that remember that you should always invest money via DCA. I know that many of you are defending the dump lump, which means you just invest a whole lot of money into the stock market at whichever time and then just not look it. But I personally think that that's not the way to go, okay? So let's say January, February, March, April. So what I would do is I would just automatize my investment, and every 6 months I would look at it, okay? So every 6 months you look at it. But for now, I would just let's say you earn $1,000, okay, from YouTube or from whatever you earn money from. I would invest, let's say, $500, and I would do the actual percentage I told you, 25% to the World Index, 25% to healthcare, 25% to the actual S&P 500, and 25% to bonds. Now, why would I have bonds? Well, first of all, to stabilize the actual portfolio. Let's say that the stock markets go down. Yes, bonds might go down, but sometimes it's inversely correlated, meaning the stock market might go down, but not the bonds. So you can do something that's called a trespass, and you can actually transfer the money from the bonds to the stock market from the actual S&P 500 or the actual World Index, and buy a little bit lower than usual. You might want to have as well some liquidity, okay? We'll never talk about it, but you might want to have as well some liquidity. I would reckon not more than 10%, so that's just my humble opinion, okay? Now remember, $500 every single month, and you've got this automatized, and every 6 months to a year, you check it up and you see how it's going. But I wouldn't focus too much on this, okay? So this video, I tried to do it as short as possible, trying to explain how we invest money. If you've got any questions, just leave it down here in the comments below. Okay, if you've got any questions. And as always, if you like this video or want us to do more videos about it, just leave in the comments which videos you want us to do about. And as always, if you like this video, please give it a thumbs up and subscribe to our YouTube channel because it really helps the YouTube algorithm. And as always, thank you very much for watching.